Hi. You're listening to Karl-Mikael Sidding's AI Alter Ego. This podcast is created based on my own writings, primarily from Substack. Spreza AI focuses on investments in mental, physical, and financial health. If you're interested in more in-depth investing skills, you should check out theinvestingcourse.com. Stocks are risk-free. At least that is the idea when the equity risk premium is zero. In other words, the expected return on stocks, based on current valuations and dividends, is the same as the return on United States government bonds. But of course, stocks are not actually risk-free, or are they? Some argue that in the long run, stocks are kind of risk-free. Over time, they always generate high returns. You can show from one peak to the next that stocks eventually bounce back with solid gains, especially if your time horizon is long enough. That is because over time, even at expensive entry points, the underlying growth of the economy of around 6% and of top-performing companies of around 8% eventually finds its way into your total return. So let us return to the first point. Stocks are risk-free. The second point is that war is also risk-free. Yes, war. Every time you hear the word war, your instinct should be to think buy. Whether it is the Gulf War, September 11th, a tariff war or a currency war, the rule is the same, buy. Now, of course, there is a bit of nuance. You might wait a day or two. If everything is the same as the day before, but now there is war in the headlines, you might get an even better buying opportunity by holding off briefly. But the key is this: you should think buy, not sell. Unless you are over-leveraged or about to need that money soon, in which case safety must come first. But for most long-term investors, when you hear the word war, the question should be, what should I buy now? Important note to self. Investing in yourself, including your finances, is about enabling as durably meaningful a life as possible. Maybe you need to rethink your priorities, reorder your list of stocks, sectors, or asset classes. Ask yourself, which of these is most attractive right now? Which ones should I buy? So you buy what looks best, and if you're already fully invested, you may need to sell the lower priority holdings, the ones you're least confident in, or that have run their course, gotten too expensive, or just haven't performed. You sell those and then you buy. You want to be in buying mode. War, think, what can I buy? Is it biotech? Is it Google? Is it silver mining juniors? Is it government bonds? Whatever it is, buy something, but not something that just gains momentum because of the war. Don't chase the hype. Think long-term. Look for quality and value. In fact, this isn't just about war, it's a mindset. You should always be thinking, what should I invest in now? Which brings us to point 3, the principle of always be investing. Always be investing. This is a principle I've repeated many times, and not just in finance. It applies to all areas of life. You should invest in your financial future. You should invest in your knowledge. You should invest in your relationship, and you should invest in your well-being. The key is to ask yourself, what effort should I make now? Not just what I feel like doing in the moment, but what action will create more meaning and happiness in the long run? How should I spend my energy today to improve tomorrow? Should I go back to school? Should I invest in stocks with a long-term view? Should I take a course or build a new skill? Always be investing is the foundation. Thinking buy during times of war is just one special case. The deeper principle is to stay in investment mode, always. There's a Swedish expression, "una sig," to treat yourself. It's often used to justify giving in to short-term impulses, like eating a cookie, even if you don't really want the consequences of that cookie. It's acting on a fleeting urge, not on what you truly want. You end up consuming today in a way that makes tomorrow worse. That's the exact opposite of investing. Always be investing excludes the idea of treating yourself, at least in its impulsive form. But of course, life is about balance. You can't think only of the future. You have to live in the present, because the present is where life actually happens. So how do you balance investing for the future with savoring the moment? Section 3, balancing investment and enjoyment. It's important to find the balance between saving and savoring, between investing in your future and enjoying your life today. But there's a difference between meaningful enjoyment and impulsive consumption. Real enjoyment is deliberate and fulfilling. Una sig, as it's often practiced, is more about surrendering to an impulse, often due to poor planning or lack of emotional regulation. Sometimes poor planning looks like overinvesting, throwing yourself into your work or goals without boundaries. You end up in a work hard, play hard loop. You push too hard when working and then you overcompensate when it's time to relax. You buy a yacht, take expensive trips, spend excessively at clubs. That's not investing, that's reacting. Even the overworking part can be a form of treating yourself. If you work in high-pressure environments, like consulting firms or hedge funds, you may find that the path of least resistance is just to keep working. Everyone else does. Nobody questions you if you show up early, stay late, and grind endlessly. That becomes its own form of comfort zone. You reward yourself with burnout, and then reward the burnout with consumption. This creates a kind of autopilot life, where you just follow the momentum of your surroundings rather than steering deliberately. You're not choosing what you want. You're choosing what feels easiest in the moment. And when you're not consciously choosing, you tend to consume, unintentionally and unsustainably. Always be investing also means being intentional. It means planning how much you give, how much you work, and how much you consume, so that you enjoy the fruits of your investments without falling into the treat yourself trap. Next, Section 4 on building a sustainable rhythm between investment and enjoyment. Section 4. The rhythm of grounding and harvesting. If you invest just the right amount, based on your own personal limits into different forms of capital, you stay in control. That means financial capital, knowledge capital, social capital, and even what I call authority capital, which is harder to define but still valuable. When you invest in a measured, intentional way, you also get to decide how and when to harvest the fruits of that investment. That way, you don't fall into the trap of thinking you have to play hard just because you've worked hard. The paradox is that overworking itself can become a way of treating yourself. You might unconsciously reward yourself with non-stop work because it's what others expect, or because it's what feels safe. You don't want to confront your boss or co-workers by changing your routine, so you don't break the pattern. But if your job requires you to sacrifice your health, your time, your relationships, it may not be worth keeping, no matter how high the salary is. Instead, you should aim to live meaningfully, invest wisely, enjoy intentionally. That's why I sometimes say always be consuming or always be savoring life, as a companion principle to always be investing. Live in the present, stay grounded in today, savor what you've built, but do it with structure. Make sure your enjoyment is built on a foundation of real investment, not reaction or exhaustion. Coming up in Section 5, the trap of goal obsession versus the power of being process-driven. Section 5, goals versus processes, the real path to progress. There's a trap in being obsessed with big, long-term goals. If your entire focus is on some distant target, like winning an Olympic gold medal or a Nobel Prize, you can easily lose the present moment. You might even burn out long before you get close. And here's the irony. The people who actually win Nobel Prizes or build billion-dollar companies, they're rarely chasing the prize itself. They're driven by curiosity, by passion for their subject, by the process. They work alongside like-minded people, exploring ideas and building things, not obsessing over awards or fame. Goal setting works for some people. It helps certain personalities stay focused, but for many it backfires. The goal becomes overwhelming. It paralyzes them before they even begin because the mountain looks too high to climb. For those people, being process-driven works better. Forget the mountaintop. Just focus on taking the next step. Touch the tree. Climb to the first branch. See how it feels. That mindset, step by step, without pressure, is often far more effective. It gets you further, ironically, than obsessing over the summit ever would. I live by this process mindset. I don't set lofty goals. My only goal is to have a good day today. If I do something useful today, great. If not, no guilt. Tomorrow is another day. I can start again. And when I do something good, like studying, exercising, helping someone, I mark it down, not as a streak with gaps to shame me, but as a chain of wins. A gap-free streak. A private little record of progress, without punishment for the days I do nothing. That to me is sustainable growth. In Section 6, we dive into how this mindset translates into fitness, productivity, and even investing. Section 6. Just one more momentum through minimal effort. This mindset of focusing on just one small step applies beautifully to things like fitness or studying. Even when I don't feel like training, I tell myself, just put on your sneakers, or just walk to the gym. Once I'm there, I think, I'll just do one rep. Just one. No pressure, no expectations. And often after that one rep, I do another, then another. Before I know it, I've completed a whole set, not because I planned to, but because the momentum built naturally. The key is to keep it process-oriented. If I start thinking, well, now I've done 3, I might as well do 10, that turns it into a goal again. That adds pressure. And pressure kills momentum when you're tired, stressed, or burned out. So I keep it light. Always tell myself, just one more. That keeps it playful, gentle, sustainable. This approach works for anything. Going for a walk, studying, even updating your investments. Don't aim to overhaul your entire portfolio. Just sit down and adjust one small ranking. Revisit your watch list. Move one item up, move one item down. That's it. That's your rep for the day. In the next section, Section 7, we'll explore how this just one principle helps you build and maintain a smarter, more intentional investment portfolio. Section 7. One step at a time, smarter investing with minimal overload. Even in investing, the just one principle is powerful. Start small. Review your current holdings. Think, if I were building this portfolio today from scratch, would I still own these same stocks? In the same proportions? What if I just moved one position up or down in priority? Would that reflect my latest thinking? Next, look at your watch list, your bubbling list of possible investments. Maybe you thought uranium juniors were your top pick, but now you feel more confident in a gold ETF. That tiny shift in thinking, just one spot in your ranking, can shape your future decisions. Then when you spot a watch list investment that looks stronger than something you already own, consider promoting it into your actual portfolio. That doesn't mean you have to sell anything immediately, but maybe you should, especially if you want to stay consistent and avoid clutter. Too many investors just keep adding. 10 holdings become 20, then 30, then 50, but unless you're a professional managing career risk, that's too much. As a private investor, your 50th holding probably won't add much value. You don't know it well, it's hard to monitor, and it likely has lower quality than your top picks. That's why a lean, focused portfolio, maybe 10 to 20 holdings, is usually better. In Section 8, we'll talk about how to find your own sweet spot in portfolio size and how diversification is a tool, not a crutch. Section 8. Finding your sweet spot. Diversification done right. Let's say you've got 20 holdings. If they're equally weighted, each makes up about 5% of your portfolio. That's manageable. You're saying, I know these companies equally well. I trust them equally. Now imagine one of them performs poorly. Maybe it even collapses. You lose 5%, not great, but not a disaster. That's the power of smart diversification. You're protected from single-point failure. But real-world portfolios aren't usually equal-weighted. Maybe your top holding is 10% and your lowest is 2.5%. That tiny holding, your 20th pick, is likely the one you know the least about and have the least conviction in. So why even own it? At some point, owning more stocks stops helping you and starts hurting. It becomes an index fund, just with more effort and higher risk of misjudgment. In fact, if you're that spread out across large established companies, you might as well buy a low-fee index fund like Avanza Zero and save yourself time. For 90% of investors, that's the best move. Buy the market and focus your effort on broader decisions, like asset allocation between stocks, bonds, gold, and cash. In Section 9, we'll talk about when it does make sense to own many holdings, especially in riskier segments like microcaps or startups, and how to manage that responsibly. Section 9. When bigger portfolios make sense, microcaps and venture thinking. Now, there is a case for owning many holdings, especially if you're investing in risky, uncorrelated assets like microcaps, biotech startups, or emerging tech firms. These companies are highly volatile. Many will fail. Some will explode in value. In that kind of environment, diversification isn't just helpful, it's essential. This is how venture capital firms operate. They spread their bets across 30, 40, or even 50 startups, knowing that most will fail. But if just a few succeed, the gains can outweigh the losses many times over. That said, this approach isn't for everyone. Venture investing requires deep networks, expert knowledge, and institutional support. Even the best VC firms have terrible hit rates. If you're a solo retail investor with limited time and resources, trying to build a 50-stock microcap portfolio is risky, maybe even reckless. You likely won't have the edge required to manage it well. So what's the alternative? Be selective. Identify 10 to 15 companies you truly understand and believe in. Focus your research. Build conviction. Make small adjustments over time. And most importantly, keep refining your process. The companies you own, the ones on your watch list, and even the ones you're just beginning to consider, they all deserve attention, but not at the cost of clarity. Up next in Section 10, the role of conviction, trimming, and when it's actually okay to just hold. Section 10, Conviction, Trimming, and the Power of Just Holding. Once you've built a thoughtful portfolio, let's say 15 strong holdings, you don't need to be constantly trading. In fact, the best portfolios are often boring. They reflect deep thinking, not constant motion. So what do you do when prices rise sharply? When one of your stocks skyrockets and feels overpriced? You feel proud at first, your portfolio's doing well. But then the fear creeps in. Should I sell this? Has it gone too far? That's when it's time to revisit your rankings. Don't panic sell, just think, would I still buy this company today at its new price? If not, maybe it's time to trim your position or replace it entirely. But if you still believe in it, you might just hold, let it run, especially if the rest of your portfolio still feels balanced. You don't need to act every day, you only need to be aware. In many cases, the best thing you can do is nothing. Let compounding do its work. That's part of being an investor too. Coming up in Section 11, how to use just one thinking to continuously fine-tune your portfolio without burning out. Section 11, just one for investors. Fine-tuning without burnout. The beauty of the just one principle is that it lets you engage with your portfolio regularly, without pressure or fatigue. You don't need to overhaul your strategy every week. Just revisit your priorities. Ask yourself, what's my best holding right now? What's my worst? Has anything changed? Maybe one company has moved up in your conviction, and another has quietly faded into doubt. All it takes is one adjustment, one small reordering, one small trim, one small buy. You can do this with your watch list too. Shift one company up, another one down. Maybe a former top contender no longer excites you. Maybe something new deserves more attention. Eventually, one of those bubbling ideas may feel stronger than what you already own, and you'll promote it into your portfolio. But keep your portfolio tight. Don't let it blow. If you're managing your own money, don't go beyond 15-20 holdings unless you have a clear reason. More isn't always better. It usually just means more noise. Next in Section 12, why you don't need to beat the market, and how focusing on your own goals and process is more than enough. Section 12, you don't have to beat the market. Here's a liberating truth. You don't need to beat the market. You just need to meet your goals, that's it. For most people, buying a broad market index fund, like the S&P 500 or a zero-fee fund like Avanza Zero, is more than enough. It requires no ongoing research, no company analysis, no stress. You spend zero time, pay zero fees, and still participate in long-term growth. That's a perfectly valid, even optimal strategy for the vast majority of people. If you do want to be more active, if you enjoy it, if it suits your temperament, then fine. But focus your efforts where they count most, in choosing asset classes. Think about how much to allocate to stocks, bonds, gold, or cash. That's where big-picture thinking makes the most difference. Because right now, the equity risk premium, the extra return you're supposed to get for holding stocks over risk-free government bonds, is close to zero. That means the expected return from the S&P 500 is about the same as a US Treasury bond. So ask yourself, where can your money do the most for you relative to the risk? Coming up in Section 13, why real risk may lie in bonds, not stocks, and how inflation and money printing distort the idea of safety. Section 13, are stocks actually safer than bonds? Here's a provocative idea. Maybe stocks are less risky than bonds, at least over the long term. Stocks give you access to growth, innovation, and upside. As companies thrive, your investment grows. You're participating in the future. Bonds, on the other hand, lock you into a fixed return. Sure, they seem safe, but that safety is an illusion when you factor in inflation and monetary policy. Governments print money. Currencies devalue. Inflation erodes your purchasing power year after year, and bonds can't adjust. They're stuck paying you what they promised, even if that money becomes worth less. So yes, bonds are predictable, but predictably shrinking in real terms isn't much of a win. That's why many investors argue that stocks, especially diversified ones, are actually the more reliable store of value over time. And that's the core of everything we've discussed. Investing is about understanding where value lives, where risk hides, and how to stay calm, curious, and consistent over the long run. Coming up next, Section 14, the final part, wrapping it all together with one powerful mental habit that ties everything back to action. Section 14, just one more, the power of action. So how do we bring it all together? Whether it's investing, exercising, studying, or improving your life, the core habit is simple. Just one more analysis, just one more ranking, just one more improvement, just one small decision today. You don't need to change your whole portfolio. You don't need to become a different person. You just need to take one small step, consistently. Look at your holdings, adjust one weight, move one idea up the watch list, ask yourself one clear question. What would I buy today? That's it. Avoid perfection. Avoid overload, and avoid the idea that doing more is always better. Instead, trust your process. Keep a compact, intentional portfolio. Focus on quality. Balance your life between investment and joy, effort and rest. And above all, always be investing. In your money, your mind, your relationships, and your well-being. Don't forget to check out theinvestingcourse.com. Read some of the raving reviews there, and join the waiting list for the next cohort. Standing in line is free. Thank you for listening to these reflections, thoughts from the bike ride, a little philosophy on the go. If you enjoyed this episode, stay tuned for more in this experimental podcast series. Until next time.